Welcome to today's Elliott Wealth Management Services 2024 Mid-Year Economic Update. Thanks for joining us today. This is Christopher Calandra. For those of you who don't know me, I am the original founder of Elliott Wealth Management Services, and I'm going to be doing today's presentation. Before we get into the content, I want to give a special thanks to the team here at Elliott Wealth Management for helping me prepare what I think you'll find to be valuable information. I'm really proud of what we put together. So special thanks to Brett DePasquale, Lindy Brock, and especially Victoria Barth. They put a lot of work and effort into this, and I'm very appreciative. So let's start with our base case. And if you had listened, and hopefully you did, listened and watched our January 2024 economic update, we advanced that our base case is for a soft landing. That refers to the idea that the Federal Reserve and the U.S. economy would be able to get inflation under control, but avoid doing undue damage to the economy and avoid a recession. So this has been a theme for us for a while now. In fact, on my podcast show, Simply Financial, I did an episode specifically about a soft landing. It was titled Dreaming of a Soft Landing. If you haven't listened to that, please check it out. It's season 7, episode 5 of the Simply Financial podcast. But the soft landing idea continues to be our base case for the economy, and that relates very closely to inflation. So let's talk about the state of inflation. If you have followed us at all, the podcast, webinars, mailings we do, if we've been in meetings together, you have heard us talk about inflation a lot over these many years. Inflation peaked at 9.1% back in June of 2022. Since then, the Federal Reserve acted very aggressively, and inflation came down very quickly, quicker than most people had bargained for, but we had that correct. We thought inflation would come down faster than most prognosticators were predicting, and we got that right. So inflation came down quite fast, and what we've seen over the last year is that inflation came down, but has now leveled off in that 3.2, 3.3, 3.5 kind of area. So that is encouraging that we got it from the really problematic 8-9% range down to that plus 3% range. But it's been stubborn at this level. If you look at the graphic, if you could picture a graph, if you're not viewing this presentation, we saw the decline, but now a leveling off, and it's stubborn. It's an issue because the Federal Reserve wants inflation to be at the 2% level. So it's a bit higher at the 3.3% level. The 3.3% inflation growth rate was for May 2024. That compared prices from May of 2023. So they increased, prices did, based on the CPI, the Consumer Price Index, went up 3.3% between May of 23 and May of 24. So the 3.3% rate of inflation, that's prices increasing in the economy, is at a manageable 3.3, yet it is higher than the Federal Reserve stated policy. So it's a stubborn issue that really is key for the economy moving forward. I mentioned the Federal Reserve. Earlier this month, the chairman of the Federal Reserve, Jerome Powell, gave some comments. And what he said is the U.S. central bank still needs more data before cutting interest rates to ensure that recent weaker inflation readings give a true picture of what is happening to underlying price pressures. So there's a couple of things to unpack here. But our view is that the Federal Reserve is passive at this point. They have not raised interest rates since July of 2023. And my view, our view, is that July 2023's interest rate hike was the last in that cycle that the Federal Reserve aggressively underwent to wrestle inflation under control. Since then, we have a relatively passive Fed. They are waiting to see what happens before deciding what they're going to do next. I think it's very unlikely that the Federal Reserve raises interest rates in this environment. Something would have to seriously change for that to happen. In the meantime, the Federal Reserve is likely to just bide their time and wait to see what happens before doing anything. Probably the next thing they do will be an interest rate hike, not an interest rate hike, an interest rate decline. They'll lower interest rates. Now, expectations going into 2024 was for the Federal Reserve to do lots of interest rate cutting this year. That has not materialized because of that stubborn 3+% inflation. There are expectations that the Federal Reserve might cut interest rates at least once this year. I think the jury is still out on that. It would not surprise me at all if they wait until after the election and after the new year of 2025 comes upon us before they actually do anything. So we have a relatively passive Fed as they wait to see what happens with inflation and economy as a whole. Let's talk about employment for a moment because it plays into this economic story that I want to lay out to you. And optimistically, unemployment is pretty low by historical standards in the United States today. In May of 2024, it's at 4%. We have 6.6 million people or so unemployed. Now, that's good news because if you go back over the long arc of US history, a 4% unemployment rate is pretty good. But in May of 2023, it was a touch lower. It was at 3.7% with 6.1 million people unemployed. So the unemployment rate has ticked up a bit. This coincides with that stubborn inflation situation I mentioned in the previous couple of slides. If unemployment gets higher and the trend line is consistently higher, that would be a sign of weaker economic productivity and would give way to more recession talk. But this 3.74% rate is a pretty good job market and probably nothing that would alarm anyone too much, but it's definitely something to watch. Is that 3.7 going to 4 just temporary and it'll trend back down into the 3s again soon? That would be good. At this state, though, again, high 3s, low 4s, I think that's consistent with that base case of a soft landing, get inflation under control, keep the economy growing. Consumer is very important in the economy. I did a podcast episode on this not too long ago because I don't think a lot of people appreciate how important the consumer is in the economy. Some 70% of spending in the US economy comes from the consumer. And so you often hear people predict about the consumer reining in spending. And if that happens, it's not good for the economy. It has a lot of consequences. But the consumer is hanging in there. Optimism fell in the second quarter of 2024 compared to the first quarter of 2024. So that's a bit of bad news. But that fall was very slight, and it only brought us back to where consumer optimism was at the end of 2023. So it's in this narrow range. Again, the consumer's hanging in there, and consumers are expected to spend more money in the third quarter compared to the second quarter. So that's good news. We want the consumer, if you're looking for a healthy economy, or not a bad economy at the very least, you want consumers to spend. That seems to be in the cards. So let's review some of these causes for optimism I just went through with you. First off, the trend is your friend. The US stock market has done well in recent history. The market had a very difficult 2022. It was a really bad year. It was a bear market, but the market started a rebound beginning, I don't know, the second week of October of 2022 and has been on a good run. 2023 provided investors with a very good rate of return, a bounce back year to be sure. This year, the markets have done very well. Most market indexes have consistently hit new highs. And if you think back to our presentation in January, assuming that you listened to that economic update, we were optimistic for this year. And part of it is that the stock market usually goes up. This was our thinking, and our research told us that the stock market usually goes up in a year when you have an incumbent president on the ballot for re-election. And when we entered into this year, we actually had 2 previous incumbent presidents. I don't know if that's the right way to say it, because President Trump, of course, had been president and lost his bid for a second term. And then you had, at the beginning of the year, President Biden. So that also added to our optimism, and that has played out. We've had a very good first half of the year in the markets. providing our investors, most investors, with good returns, adding on to what was gained last year and put us farther and farther away from what was a mess of 2022. Our expectation for the second half of this year is for the markets, most indexes, to finish higher than where they are today, but not be as explosive as it was in the first half of the year. So we think we could continue to make gains, but much more modest as we finish up 2024. That's our thinking. And this is backed by what we talked about already. We have manageable inflation, a passive Federal Reserve. We're expecting interest rate cuts to be the next act of the Federal Reserve, possibly one rate cut before the end of the year. We have low unemployment, although it's ticked up a little bit. And as I already described to you a couple of times, the consumer is still hanging in there. So those are some of the causes for our optimism, and I think that they are pretty impactful. As I am prone to do, I want to give you the other side of the debate, if you will, and talk a little bit about some of the things that has me and the team here worried. Many of these you would have heard of and probably have an awareness of, but let's talk a little bit about it. To begin with, I want to start with political uncertainty. I have been saying for a while now, in speaking with clients as we review their financial plans, their asset allocations, their financial goals, about the craziness of the presidential election. And it's kind of a catch-all. If you're a Republican, if you're Democrat, if you're independent, if you don't follow politics, it kind of captures it all, that this would be a crazy election season. I'm not going to get into the details of everything that's going on, but what I want to share with you is that all of this uncertainty, this craziness, is not helpful. The market likes certainty, and it never has certainty, right? We live in an uncertain world. But all of this craziness, all of this unprecedented activity, the language, the players, the circumstances, it all leads to just general angst. And I'm talking about the economics behind it. Now, the markets, as I have said, have done very well in spite of this uncertainty, this craziness, all of this unprecedented stuff happening in the political world. And even though we're worried about it, unless it gets out of hand, and I could make, if I wanted to make a darker prediction, if I was on a debate, I could probably come up with a lot of scenarios that would be scary, if you will. But history tells me, history tells us, that probably is not in the cards. But it is something that we are going to monitor in the second half because of all of this craziness. Using history as a guide can be helpful, but at the same time, there's a lot of new stuff at play in 2024. So we want to be on top of that, and we will be for our clients because we want to do a good job for them, and paying attention to what's happening in politics, unfortunately, is going to be a key ingredient to the work that we do. And it has been for some time, but that's only intensified. I want to talk a little bit about household net worth. Again, if you followed me at all, at Elliott Wealth Management, we want our clients, and I do this personally, is to keep track of one's net worth, to have either using a technological platform, and we have a great one, or a pad and paper, or an Excel spreadsheet to keep track of your net worth, to consistently review your assets, your debts, and you find out what your net worth is by taking the sum total of your assets and backing out the sum total of your debts, and that gives you your net worth. And when you're thinking about financial planning and wealth building, keeping track of this seems to be very wise, and we're big proponents of that. It's been personally a huge, huge motivator for me over these many years. I bring that up because I saw some research that talked a little bit about household net worth in the United States. Now, this is not a political presentation, but I have been talking to clients and on the podcast show about Americans being in a sour mood. It's a constant thing that I say. The US is Americans are in a sour mood. And when I saw this research that I want to share with you, it kind of put into focus at least part, maybe even a key part of why Americans are in a sour mood. So let me lay this out for you. In President Trump's first 3 years as president, household net worth increased by 23%, an impressive number to be sure. Under President Biden's first 3 years as president, that brings you through the end of 2023, household net worth increased by 19%. Still an impressive number, but a little behind President Trump's first 3 years, 23 versus 19. The key thing about this is that is just a gross number. That doesn't take into account inflation. When the research accounted for inflation, it found that during Trump's first 3 years as president, adjusted for inflation, that means once you took into account what money can buy, what the wealth could buy, when you factor in price increases in the economy, the household net worth under Trump's first 3 years as president was 16%. So some of the 23% was erased by inflation, but President Trump enjoyed, as did President Obama, very tame, benign inflation. President Biden, whether you want to blame him a lot, a little, or not at all, experienced quite a bit of inflation during his first 3 years. So he had 19% net worth increase, but once you factored in inflation, that went all the way down to 0.7%. This is worrisome politically for the Democratic Party and the incumbent party because American families in the aggregate have not built much wealth over the last 3 years. I don't have numbers for 2024, so I'm talking at least through 2023. American households have not made much gains in net worth. That is not a sign of health. And to me, at least, it explains some of this sour outlook on the economy and why the incumbents are not getting good scores in terms of their views on the economy. And give President Trump credit, and granted, he did inherit a good economy from President Obama, but it's a stark difference. And when you look at the economy, I would question how long can the markets continue to thrive, to make new highs on the various indexes, if most American households are not becoming wealthier, especially when you factor in inflation. So I wanted to share that with you. It really made an impression on me. Next, let's talk about geopolitical unrest. There's a lot going around in the world. This is always something. Anytime you give an economic update and anytime you talk about things that might be worrisome, you could always talk about geopolitical unrest. The world always has at least some areas of either shooting or the risk of shooting. And we've had more of that over the last couple of years than we did previously. This began with Russia's invasion of Ukraine back in a few years ago, and it's an ongoing conflict. It's still a problem, and more importantly, in terms of the risk, is the unrest surrounding the idea that the conflict could spread. If you look as an example, and we're not going to do a deep dive into this, but French President Macron has indicated he would be open to NATO boots on the ground. He has talked about maybe even French leading the effort and putting troops on the ground in the Ukraine. That would be an escalation. And maybe that would be good policy. I'm not saying it wouldn't be, but I'm saying that such actions would increase risk of that conflict accelerating, spreading, causing more trouble around the world as that relates to the economy. That could be problematic, including potentially an increase in oil prices. And when you have oil prices spike, that usually comes at a price for the economy, and the markets generally react badly to that kind of thing. So that is a what if. There's always what ifs, but it's something that is a little bit more at the forefront of people's thinking because of the hot war that's going on in Russia and Ukraine today. Additionally, we have the Middle East that is always an issue when you think about geopolitical unrest, but it's gotten much nastier since October 7th. So you have Israel having an incursion into Gaza. Tragic. A lot of people since October 7th have died on both sides. Nasty stuff. I'm not going to comment on who's right, who's wrong, or even policy. But this is not something that's likely to affect the economy. These are relatively small players in the large economic stage of the world. But when you have these things spread and you have more combatants and you have risks of a wider battle or even war, it could be problematic again because of oil. That's a key way that could play out. You have a spike in oil that hurts economies around the world, including the US. Markets usually react badly to that. Let me add that there's increasing risk that the spread of the fighting will begin to include Lebanon, and you have Hezbollah, one of these so-called terrorist organizations. I think that's officially how they're labeled. I'm just trying to be sensitive to everybody's views. But that would be a sign, if the shooting starts between Israel and Lebanon, of a wider conflict. That seems to be more likely today than it was, let's say, 6 months ago at the beginning of the year. So we're going to take a look at that. The next couple of slides, I want to talk about the finances of the US government. And you hear this a bit if you watch or listen to the news. I tend not to talk a ton about it, but I did want to bring to your attention some of my thoughts and some good data, I think. So to begin with, government spending in fiscal year 2024 is going to be about $6.5 trillion. I realize it's difficult for most, if not all of us, to kind of picture and appreciate what $1 trillion is, but to say that it's a lot of money. So the government spending is about 6.5 trillion, and that is higher than the revenue. The government is spending more than it brings in on a fiscal year basis. So every year the government brings in money and it spends money. It's going to bring in about $4.9 trillion, which is a record. The government brings in a lot of money. It brings in more money seemingly every year. Additionally, though, the government spends more money every year. So there's always, not always, I guess if you go back to the Clinton administration, it wasn't the case, but I'll say consistently, reliably consistently, the government spends more than it brings in, which means it needs to borrow to finance the difference, just like you would do as an individual or a family, and just like a business would have to do. So the 2024 projected deficit is 1.6 trillion, meaning in fiscal year 2024, the government expects to spend 1.6 trillion more than it brings in. They'll have to finance that debt. And that also means, if you did some quick math like I did, the government's going to spend about 25% more than it brings in. That's not good. That's not healthy. It's worsening over time. Even though we're bringing in more revenue over time, the government is, we're spending money at a growth rate that's higher than the growth rate of the revenue. It's an ongoing issue. It's not going to be easy to fix. I'm not even going to pretend on this presentation to talk about solutions. But what I did want to bring to your attention is that this is a problem that's been talked about for a long time. I've been in the business for over 30 years. It's been talked about probably my entire career. Sometimes it's a more topical issue than others, but I do believe the next president of the United States, whoever that is going to have to deal with this in a much more significant way than their predecessors, because this cannot continue. And I think the point of needing to deal with that is fast approaching. By the way, if you look out to 2025, the projected deficit is 1.8 trillion. I wanted to share that with you so that you could reinforce the idea that this problem is growing and not improving. Related to this is the US debt. Again, a topic that I tend not to talk much about, but I think I can make a very good case that it's something that's going to need to be dealt with. My prediction is the next president will have to deal with US spending as well as the national debt. The national debt now stands, well, now at the end of 2023, stood at $33.1 trillion. It is growing by $1 trillion every 100 days. That's remarkable. It's growing at $1 trillion every 100 days. That's $3.6 trillion a year that's added to the national debt. Now, I like to think about things in terms of percentages. I talked about in the previous slide, spending. We're spending 25% more than we're bringing in. Because regardless of whether it's a billion, a trillion, a million, or thousands, when you think about the percentages, it puts the ratios in perspective for me, and I think for you too. I think it's a good way to communicate economic and financial concepts and statistics. So if you take 3.6 trillion per year, if that in fact is the number, and you add that on to 33.17 trillion, that's about an 11% increase. So that means that the US debt is growing at about 11% a year, which means at that rate, if that continued, which I do not believe it can, would have a debt of about 66 trillion in 10 years. That seems very improbable to me. It could not happen. I don't think it will happen, which means something has to change. We could talk about what that would be. I'm sure people of different political persuasions have different views on that. But that's a significant issue. It's not for the balance of 2024, but I would not be surprised if it's a key issue that Elliott Wealth Management and the political world and the media will talk about in the years 2025, 2026, 2027. I believe it's an issue whose time is fast coming. Last thing I want to talk about before we sort of wrap up the worries, and hopefully you're not freaking out as you listen to this or watch this, is de-dollarization. I just want to touch on it because there's been a lot of doom and gloom marketing, especially in social media, email blasts, pop-ups, talking about the sky falling. This is an issue like the debt and the deficit that's not really a short-term issue. It's a longer-term one, but it's one I just wanted to mention at least briefly. So the US dollar is the world's reserve currency, and that gives the United States power and influence around the world that we've fully taken advantage of over the last couple of generations. Back in 1974, Saudi Arabia had a deal with the United States, a 50-year agreement that had them do business in dollars. With that deal, other countries around the world adopted that same posture and do business in dollars. That increased global demand for US dollars and increased the potential for the US government to borrow money because there's a lot of dollars floating around the world and countries needed dollars, including our opposition or even our enemies. China needs dollars, Iran needs dollars, Russia needs dollars, the list goes on. So what happened recently is Saudi Arabia decided not to renew their 50-year agreement. They decided not to, which opens up the possibility and even the likelihood that they can do business in other currencies. Now, the doom and gloomers will have you think that this will be a catastrophe in the short term. They might be right in the long term if things played out in a certain way. But my view is that the dollar status of the world reserve currency is under threat over the long term, but not under threat in the short term. This is a dangerous thing for the country, I think, long term. But the reality is there's no currency in the world today that's positioned to replace the dollar. The dollar has flaws. The US has its issues with its debt and deficits, and possibly not as influential around the world as it used to be. Again, that's debatable. But the reality is there's no currency that's positioned to replace the dollar. And that's why I view this stuff that's happening in social media and these email blasts by certain outfits, this doom and gloom, is misplaced. The euro cannot replace the dollar today as the world reserve currency. It's not strong enough. It just is not going to happen. The yen, which is the Japanese currency, no way. The yuan, it's the Chinese currency. It's manipulated by the Chinese government, and its value is pegged to the US dollar. So it's almost itself reliant on the dollar in terms of valuation. So I wanted to mention that in the recently, I've had at least 3 clients, smart, intelligent, experienced investors asking me about this. That's why we included it in the presentation. So let's just kind of wrap up reasons to worry. Political uncertainty and upheaval. We have a lot of that, more than you'd expect in a presidential year. It is crazy. You can make some pretty dark predictions. You can make some optimistic ones. We're going to watch this closely. But generally, all of this uncertainty is not typically very good for the markets. So far, it hasn't had an impact, but I want to see how it plays out. I talked about the stagnant household wealth, that's not a great sign for the economy, that the numbers show that household wealth, when you factor in inflation, hasn't grown over the last couple of years. How long could the markets and the economy thrive with that as a backdrop statistic? We have the geopolitical tumult I talked about, worried about the debt and deficit in a way that I haven't been ever, probably. And then I touched on de-dollarization and the long-term status of the dollar. Once again, I don't think a short-term issue, not going to be a presidential election topic, I don't think, but something in the long term that I want to be aware of, not just as a financial planner, but also as a citizen and a father. So what can you expect from us as we finish up here? This is a standard slide for me. If you've listened to presentations before, economic updates before, is we are regularly reviewing changes that might affect you. We are going to communicate with you regularly and a lot. We're reviewing economic, tax, estate, and investment issues for our clients. We want to help them win with money. So that is our calling card. Your health, your well-being is our highest priority. We are here to help our clients as best we can. And for you that are listening and watching, we really appreciate the opportunity to help you with your financial needs. We are always planning for your success together. Thank you for listening and watching to this 2024 mid-year economic update. I appreciate you taking some time. I hope you got some valuable takeaways and found this to be informative. If you have any questions, comments about this material, how it might affect you, please reach out to us, email us, call us, go to the website, elliottwealth.com. You could sign up for a consultation there, but let us know your thoughts. And once again, thank you for tuning in today.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues, or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.